Okay, well, I'll just get us kicked off. And as I see people join here, I guess I'll have to manage the admittance as I'm rolling. So I'll just kick us off. We are going to talk about year-end planning. So I think you're in the right place if you want to be strategic about your taxes. We're going to talk a little bit about how we look forward, how we project out what tax liability is. We'll talk a little bit about some best practices. But I think the punchline here is this isn't the end all be all. So if the expectation is that one webinar is going to solve all your tax and accounting problems, I'm sorry to disappoint, but I'll disappoint you up front. This webinar isn't going to be it, but we'll start talking about what the key issues are, and we'll talk a little bit about how we as a firm handle that. I see a mix of clients I know very well on this call, as well as some new names. So if you guys don't know who we are, welcome. We'll tell you a little bit about us and how we solve tax issues. With that, Sean, I'll let you give us the agenda overview and as well as the first item on the agenda.
Perfect. Thank you so much, Miguel. Yeah, so I'm just going to start off by reviewing the team. As Miguel mentioned, there are some familiar names here. For those of you that don't know who we are, we'll go over all that. Also, just kind of very basic overview of taxes, income, expenses, and entities. We'll also be reviewing some tax forms, show you what they look like. And then Miguel will jump into some case studies and strategies, just more specific tax strategies that we implement with our clients. And then we're also going to cover some key points for tax planning. Basically, what you should walk away with, the knowledge you should walk away with after the end of this webinar. So just disclaimer, our lawyer insists you read this. None of what we discuss today will be any or should be taken as any guidance for you specifically. There are always exceptions to what we have to say, and that exception could be you. So please do not act on anything you hear on this webinar. If you have more questions, more specifically, then please let us know and we can get you going in an engagement. We'd be happy to advise you on your specific situation. Okay, so starting with announcements and team. For our first announcement, we are currently doing our wrapping up our Q4 planning for our on-ramp and retainer clients. I'll address what a retainer on-ramp client is later on in this call, but we are doing the Q4 planning for them now, and then we're going to start doing Q1 planning. So if you are currently in a engagement with us, either on the on-ramp or retainer, we'll be reaching out to you shortly to start the Q1 planning for next year. Also, the Q4 taxes applies to a lot of people. Q4 taxes are due January 17, 2022. So make sure that you do pay those by then. Now, if you haven't made any estimated payments throughout the year, then you do have to true up until the 31st of this year. So you're basically paying your tax liability from the first of this year to the end of the year. If you have made payments throughout the year, then you should be okay. You probably won't have to submit that big of a payment, but if you haven't, then make sure you do so by the 17th. And then as far as the PPP forgiveness goes, you have until 10 months after the last day of the covered period before having to make loan payments on that. Okay, so who we are. At Shared Economy, we really focus on tax deductions. I think that's a huge part of our business, and that's why our clients appreciate us. So we're really focusing on tax structuring. We also offer entity structuring services, and a lot of our clients are also looking for bookkeeping services. So that's a main focus, or the three main focuses of our services here. We specialize in 1099 earners, more specifically Airbnb and Turo. So again, I'm sure a lot of you guys that are current clients with us are familiar with that, but we are just trying to assist our clients in building the best systems around their taxes and accounting to save them as much money as possible. So we've been featured on several different publications. You can see them here. Miguel actually testified in front of the U.S. House of Representatives a while back. So we have a pretty decent. I'm sorry.
Said I don't think I would do that again.
Surprised you did it once. We've been featured quite a bit. We have a lot of experience in the space, and we're working on partnerships constantly with new organizations. And so hopefully, we want to bring that expertise to your tax situation as well. So here's our team geography. We're made up of 4 regions. I don't want to read out all the states to you, but just so you can get an idea of where we operate, how we operate. This is kind of where our main hubs are, I guess you could say. And here's our team. So starting from left to right, that's Carla. She's one of our tax compliance officers, and that's myself, second from the left. Mike Tripp. Thank you. Mike Tripp, second from the right. He's our main advisor and tax manager. And then we have Tina on the far right, who's our bookkeeping manager. Okay, so these are our different lines of services. We have our compliance and controversies. This is where we're really focusing on tax returns, payments, tax audits. We have reporting and diagnostics, bookkeeping essentially. So this is where Tina is really focused. We help our clients build up different bookkeeping systems, set up different types of accounting systems like Wave or QuickBooks. We're also doing the automation and rules for our clients as part of the bookkeeping service. And we also do a lot of tax and strategy. So I mentioned earlier the on-ramp/retainer program. That's where this falls. And we're really encompassing, and the strategy advisor, really encompassing a lot of our services underneath that kind of on-ramp and retainer program. Okay, and here's some basics for you guys. So as far as taxes are concerned, if you earn more than $400 from a platform, so whether that's Turo, Airbnb, Getaround, VRBO, Verbo, then you need to report that income. So the biggest consideration is self-employment taxes. So as a part of being a Schedule C activity, so active income, you do have to pay the full 15.3%. Whereas, as I'm sure a lot of you guys are used to, if you're just W-2'd, you're only paying a little less than half of that, about half. But if you're doing Schedule C, which a lot of you are, then you're paying the entire thing. So that kind of circles back to our bookkeeping services. It's important that we're able to track deductions, because we're able to deduct your expenses against the tax percentage that you're paying. So get familiar with the concept of net revenues and net profits after deductions. It is not about revenue. We really focus on taking deductions. So again, very, very clean and systematic bookkeeping systems are necessary for this. If you ever get audited, it's very easy to show the IRS like, hey, here's all of our books. It's very clean. And generally speaking, they'll go away. So it's really important that we get that down. And there are a lot of regulations legal, depending on which state you live in. There may be local and municipal rules around car sharing or home sharing. So just make sure you look out for that. A huge one is New York. That's kind of a pain in the ass to have an Airbnb in. So just keep that in mind when you're opening up these businesses. Make sure you look at local regulations to make sure there aren't a lot of barriers for you to go through.
Yeah, and Sean, I'll just add, these are kind of the three main points. And if you were to drop, and anyone on this call that we're dropping 5 minutes, I think these are the kind of key points, right? Is from a tax perspective, we're really focused on, are you a loss business, a strategic loss business, or a profitable business, in which case you're subject to additional taxes. From an accounting standpoint, I'll say it a little more technically, that you've got to be able to work up and down the P&L. Most times, when we work with the client right off the bat, the number one thing we hear is, well, this is what we charge from a nightly perspective. This is what we make on a monthly basis. And I get it. The first year of entrepreneurship, first year of starting a business, you have one goal, and that's to make revenue. But once you meet that goal, you've got additional ones, and those are different parts of the P&L. And the last thing, I think, we're going to have to undersell it and not talk about it after this slide, but it's actually a headline in some sense. The amount of regulation on short-term rentals or car share is starting to increase as municipalities get hungry for taxes around this. So it's a growing area, a place that we're giving attention in terms of the content we're producing. We're keeping tabs on it. But again, it's not going to be the focus of this webinar. All right, Sean. So I guess this is I jumped in at my point here. So I'll take it over from you, Sean, if you're good with that.
Perfect. I'm totally okay.
All right. So I'll talk a little bit about the basics around income and expenses. One of the things, the slides, is this webinar is for you if, I would say this webinar is not for you if you are already a monthly client or a retainer client that has gone through a lot of this process, because what we're going to cover are some of the headaches that most Airbnb hosts, most car share hosts most 1099ers that haven't really spent time on this are going to deal with. So forgive me because this is going to be a little 101. I know there's always folks on the call that are going to say, I know this. I want to get into level 501 tax, special depreciation for improvements. We'll touch on that a little bit, but just stressing some patience. And you know what? I think even for me, sometimes when I revisit some of the basics, I'll learn something new. So the first question I'm going to ask is, where do you go to find your income? And oftentimes, where you will go as a host is you'll go into the app. You'll go into the platform. You'll see we're going to say these are going to be specific steps to calculate your tax liability. So we're going to have you specifically go to gross payouts, and you can pull your gross payout history by year in Airbnb. I can't screen share it here. We don't have the time. But what you should get once you export it correctly is you should get a CSV that can be translated into Excel doc or a Google doc that looks like what you're seeing on this screen. You're going to have a reservation code. You're going to have date, number of nights stayed, as well as the gross amount on the far right. Now, you're also going to see occupancy taxes. You're going to see the Airbnb fee. The point is you want to be able to have all that detail because you can treat it differently. I'll also talk a little bit about Upwork. It's the same concept. So whether it's Upwork, whether it's Airbnb, I want to be fair to all the platforms here. You're going to have the same system where you can go in and you can pull your transaction detail, and then you can see here that we're adding it up. So there are deductions from that gross amount that are very, very important. And in fact, if I were to give you one thing to write down now, it would be gross revenue needs to be reported on the tax return, but so do the deductions. So for anyone on Upwork, you know that there's a commission fee. The same is true with Airbnb. And I don't need to tell my Turo or Getaround hosts that's the thing, because your fee is 20% of revenue, where Airbnb is 3%. It's also an important metric to look at. You don't just want to look at your net earnings, although of course that's what you mathematically will get to. But the reason you want to look at that difference is because sometimes those fees are different between platforms. And I know we have an example of a client who was on Airbnb, was also, I think, on booking.com. And they looked at the difference in what they were getting in fees. They're like, you know what? Booking.com is not even worth it. I'm paying so much in fees. I'm not even getting a lot of reservations. I'm just going to focus on Airbnb. So sometimes those aha moments come from looking at the detail and income. Don't have a Turo example here, but if you do want one, put it in the chat, and we'll put your email in the chat, and we'll email you what the Turo version looks like. Okay, a 1099K. Webinars are somewhat limited, but if we were in a room, I would kind of, or maybe I think you can raise your hand in Zoom, but raise your hand if you've ever gotten a 1099K. Chances are it's going to be very few, because there are 2 requirements that you have to hit to get a 1099K. These are changing with the platforms, and Congress is actually looking at changing the requirements and threshold. But right now the threshold is as follows. If you hit 20,000 in revenues, a lot of you are saying, I did that, right? No problem. And you have 200 transactions. So it's an and on nor. Then you get a form 1099K, and this is what it looks like. And essentially, it is going to be the gross revenue amount that comes through the platform, meaning it is not going to be the net revenue. Also meaning that when you file your tax return, the number that shows up in 1A is going to be the number that you need to report as line 1 on your Schedule C, on your partnership return, and we'll show the examples, and I'll make reference to this so you can see 1A right there on the 1099K. I know it says 2017, but it hasn't changed. And that's the number that you're going to want to report. Now, if you are like the clients that I used to work with, you say, but Miguel, I didn't receive all of that money. I know. That's where the pull that we're talking about from getting from the platform is important, because that is going to have the amount that was subtracted for occupancy taxes, taken out for fees, and don't even get me started on adjustments, because that is a whole other headache that we won't get into. So that's income, right? So once you have income, we're going to write that number down, right? And we've got some Excel sheets, some that we'll actually share with you, where we have a process for documenting, but you're going to write that down. That's going to be your starting point, right? And of course, you're going to subtract out your commissions and fees, which we talked about. And now we're going to talk about expenses. Before we talk about expenses, I like to put my clients through something where they start creating a mental chart of accounts. So before we get tied up on what chart of accounts are, general point is that you have categories of expenses. And especially from a business perspective, you're going to have different default categories if you are a service business, right? You're not going to have a lot of depreciation. You're not going to have cost of goods sold. And it'd be very different if you were an Airbnb. You are going to have depreciation. You're going to have mortgage interest. You're going to have platform fees. You're going to have local taxes, and those might be very different depending on where you're located and what business type you are. But this is a call dedicated to, sorry, I had to mute someone. This is a call dedicated to sharing economy. So from our perspective, these categories are somewhat defined, but the idea is that we want you to start writing down, and what we have our clients do is we have them look at a full list of transactions that they've done in a bank account. And by the way, if you don't have a separate bank account for your Airbnb business and you're making around 10,000 in revenue, you have enough transaction to create a separate bank account, and you should. I'm not going to prove that out right now, but if you haven't done that, literally do it before Thanksgiving. It's really important. But the point is, we want to look at your transactions, and I want you to do an exercise where you start looking at these and you start thinking about what categories you would put them in. And what you should end up with is you should end up with a list of similar transactions and categories that are repeatable. The idea of a chart of accounts is it's simply a list of categories in which transactions can be bucketed. And I'm going to say right now that the less categories, the better. I'm going to put a big asterisk on that and say that if you're putting things in the wrong categories, that's the limitation to that statement. But if you're at a starting point where you haven't done this before, take a look, take a screenshot of where these are. And we have chart of accounts for every type of business. And it's something that we give to our clients. Sean, we'll have to think of a way to put it in a Google Sheet and maybe email it out after, because we're happy to give that away. But the point is, you want to have a fixed amount of chart of account categories of expenses that you can consistently, repeatably put transactions to. And what's going to happen is you're going to come up with a mental map of where things consistently go. What I mean by that is you're going to start seeing a transaction that, let's say, is at Home Depot. And at first you're going to say, wait a minute, what was that for? Was it paint? Was it for the room? Oh yeah, but I remember Bob picked it up because we needed more mortar for the bathroom. I'm renovating right now, so this stuff's really relevant. And you're going to say, man, where does this go? Well, I would say that'd probably be supplies, and it's not on here because it's not comprehensive. But those are the kinds of things that you're consistently going to do. And by the way, if you put that into an improvement category from a tax perspective, you have to depreciate it. So eventually it becomes a little tricky, but step number one is get a list of your transactions and start bucketing them and categorizing and create that repetition, that map. Step two, I would say, is getting feedback, because some of these business expenses are tricky. So I was talking about, we've got the first point here on depreciation, 27 and a half years. I'd be curious if anyone knows the history behind why it's 27 and a half, not 30, but basically on a house, the depreciation lifespan that the IRS came up with it's got to be 1985 under the macro system, gave 27 and a half, and it's the same period that we use ever since. Here is, I think, what's usually a surprising point to clients is that if you work on improvements, so if you fix a bathroom and you put that all as an improvement, that also gets depreciated over 27 and a half years. And yes, I've had the conversation with clients where he said, hey, I spent $30,000 on this bathroom and you're telling me I get $1,000 deduction? And the answer is yes. If you leave that alone as is, as an improvement, it does. And that's why it's important to have categories where you're putting things into supplies, where you're putting things into fixtures, because those can be expensed. Accelerating depreciation, Section 179. We have tons of blog posts about it. If you Google shared economy CPA, Section 179, you'll get a lot of the context that I can't get into around what items qualify for immediate deduction. So 1 year depreciation is essentially what you get. Again, the concept is that the money that you spend all at once is not immediately deductible. You have to spread it over life, unless there are certain rules that apply where you can accelerate that deduction to being 1 year. Those are often the situations where you get very good tax strategies. So if you're going to write something else down, accelerating depreciation is good from a tax perspective. If I were to make it even better, I would say accelerating depreciation on something that is financed is even better. What I mean by that is, talked about my $30,000 bathroom. If you pay cash for it, you're out of cash and taking the deduction on the cash spent. However, if you take out an equity line, or if you put this all on the credit card, or you find a way to finance this over multiple years, you can still get a deduction for the full amount this year, even though you're not out that cash. So you can start to see, there are ways that if I did this consistently, if I did this on multiple investments, that I would have a very aggressive tax strategy. And believe me, our clients do. There's a little beware here. Is it be aware or beware? I'm not sure. Let's say it's both. So beware of the home office deduction. So for those who are sharers, meaning that you live in the house that you also rent, a lot of clients that come to us their first year, they put it down as a home office deduction. It's not the best way. Number one, it does get reviewed, especially if you're filing your own tax return. It does get special attention. Some research we've done, the IRS thinks, hey, they were probably really aggressive. There's a lot of rules around the home office deduction that needs to be exclusive. They probably did it wrong. Let's send a letter to get this reviewed. We probably want to get that off the books. So there's a certain way to do it based on days, based on availability, that we actually do as a tax strategy. So be aware for those that are also, you're using the car, you're renting it. There's a way to allocate use based on business that we want to talk about. Again, can't do that completely on this call. Okay, what about business systems? Sean talked about it a little earlier, accounting systems. What we do, we default to QuickBooks, we default to Wave. We are working on an application right now specific to Airbnb that is going to auto-categorize transactions based on all the data that we're collecting. Coming soon, but it's called Control B&B if you want to look it up. For now, if you don't have any system, this is the slide where I say, okay, look, if you're not going to do anything around accounting systems, maybe there's a lot of mental friction around, do I get QuickBooks, which, man, it costs money. It's kind of hard to understand. It's not really user-friendly. Do I use Wave apps? By the way, these are all things you guys should research if you've not looked at accounting systems at all. Wave apps, it's free, it's user-friendly, but Miguel said it doesn't really make sense if I have multiple properties. I need something a little more sophisticated. Well, you can sort that out, but in the short term, what you should do at minimum is create a deduction list. We have a deduction list that requires 4 items, and then I'll show you kind of what we do at the end of the year to get this caught up. But for clients that have nothing, we say do this. Create a spreadsheet with 4 necessary columns. You'll see that there's actually 6 here. So if you want to be an A+ student, put 6. If you're okay being a B student, 4. So you need date, you need vendor, you need business purpose, and amount. These are the 4 things that are required to create a legitimate deduction from the Internal Revenue Code. So this is the IRS. I'm saying be a superstar, add item detail, because what you can do is you can create a practice of documenting what exactly you were buying. And then 2, back to my earlier point about accelerating depreciation, we can actually figure out whether it's something that needs to be an improvement and therefore depreciated over multiple years, or whether it qualifies for accelerated depreciation. So again, if you do nothing else and you caught my point about accounting, tax, and regulation, and you take a screenshot of this, you will be ahead already of those that are going to wait till the last minute. So make sure you have these, because what we're going to get to when we get to case studies is that based on where you are at from an income standpoint, right? So now you've got your income, You've written down all your expenses. You know which ones are, I'm making an assumption here, but you know which ones need to be depreciated. You've taken that number that needs to be depreciated, divided it by 27 and a half. Okay, that's how much you get this year. And then you add up all the other little things that you subtracted. There you go. You have your deductions. Your income less your deductions give you your net profit. Whether or not you're still in a positive position or a negative position is going to influence whether or not you need to do things additionally for the rest of the year. What's also going to influence what you do is your entity type. So here is where I'd say kind of the other pillar of what we talk about. This is where we look specifically at what you do from a tax perspective, depending on how you're set up. And some of you might say, well, actually, Miguel, I'm really thinking about next year. I'm really thinking about 2022. So let me talk a little bit about entity types really quick so that you've got at least a level 1 overview of what we mean when we talk about entities. Entities are a legal term for a fictitious organization. So there's really no such thing as an LLC when you create it. It's a piece of paper, but legally it creates a separate entity. From a tax perspective, entity is going to be a little different. What I mean by that is that a sole proprietor is going to be a tax entity, but not legally a tax entity. A tax entity from a legal perspective means that you have a separate operating business that can legally own and operate just like a person. A sole proprietor is the one that falls outside of that. So what is a sole proprietor? It is what you are by default if you start a business. File a 1040. Specifically, you file a Schedule C. I'm just going to pop over to the Schedule C. This is what it looks like if you're one of our clients. This is what we go over. This is what we prepare for you. Essentially, what you can see in the top half is it's informational. Part 1 gets to income, right? That's going to, like we said before, that's the gross is going to, line 1 is going to tie back to what our gross is from the platform. And you can see that there's additional items here that's going to get us to our net revenue. And then everything we've added up is going to go into part 2 expenses. And if you go back to what we were doing here, you'll see that based on what these items are, what we do is we create tax categories. Tax categories are the specific line items that are line 8 through 26. So you saw I had supplies. Supplies is line 22. You saw in the previous slide on the far right, you see that there are some repairs right there on that second line. Repairs are going to show up on line 21. So there's some method to this madness. We're not just BSing you guys. But the point is, sole proprietorships are not separate. They're filed as a schedule onto the 1040. LLCs. So there's 2 kinds of LLCs from a tax perspective, and it's very important you know which one you are, which one you want to be. There are LLCs that are taxed as partnerships. That's going to be a separate tax form. And there's going to be LLCs that are single member LLCs. Maybe you're a sole proprietor. You're like, hey, you know what? Legally, I wanted an entity. I want to get a credit card that doesn't affect my personal credit score. By the way, great reason to get an LLC, even from legal aside. You max out a credit card that's on an LLC. Yes, they're going to pull your personal credit. Yes, you're going to be personally liable, but you can carry a balance on that LLC credit card, and it will impact the EIN's LLC credit report. But it doesn't, if you pull your own credit report, you won't see that credit card. So for those of us that actually need to put our business on a credit card, it's a good reason to set up an LLC. So 2 kinds of LLCs: partnerships, which file a 1065. Very important for our clients. And I know we have Leah from our admin team on the call. She really cares. It really does matter when you have a partnership return, which is a separate engagement than an LLC. Why is it different? It's not just about what we care about. It's that it's a separate tax form altogether. So where a partnership or a single member LLC will file a schedule to your regular personal, a partnership is going to file a completely separate return that gives you a K1. So the K1 goes to your personal. The partnership files its own tax return. So if you're kind of, I want to be a partnership, if you don't have a partner, you're not going to be a partnership. Partner is somebody you're going to split income and expenses with. There's no reason to do that unless you're legitimately in need of operating a business with a partner. And I don't mean a spouse. I really mean someone that doesn't file jointly with you, that you are splitting income and deductions with. The other key point is that it's all pass through, meaning that they don't have their own tax rate. You'll see 22 to 35. Those are your ordinary rates. So whatever the income is, if it's $100 from the partnership, that's what's going to be taxed on your personal. So it's going to have your W-2, it's going to have all the other items, and then the K-1 from the partnership added to that. And the same thing with an S-Corp. This is not the call to talk about S-Corp versus partnership versus LLC. It's one of the top questions we get. I guarantee that there's 5 people on this call that want to know about it. The point is going to be separate return as well, special tax rules. But the punchline, if you want one, is going to be it only makes sense to be an S-Corp. I'll die by this. I mean, you guys can quote me on this, and I don't know. I've had other accounts kind of, jump on this, but I'm just going to say as a basic rule, if you don't have 50K in net income in your business, net income, an S-Corp is not going to have that great of a benefit. And I'll show you in a little bit, if we have time, LLC to S-Corp planning, if we have time. Last one is C corporations. These are only really going to make sense if you're taking on investment, if you have some serious legal concerns. Typically, we don't see this. Typically, the number one entity that we're working with in real estate and in Airbnb and in Turo is going to be a single member LLC or a partnership. The only time I'll make an exception to that, property management companies that are very profitable, once they hit certain scale, an S-Corp begins to make sense for them. S-Corp return is going to look a lot like the partnership return. You can kind of see it here. It's almost the same thing we're talking about. You can see here again, 1A, gross receipts, right? Back to my previous point, the gross receipts matters, and then we will deduct out whatever the fees are elsewhere. Again, the point here is the S-Corp is going to be a different tax treatment, but it works the same way in that you get a separate return and then you file a K-1 onto your personal. All right, so let's talk about case studies and strategies. I'm going to need to run through this quickly, and then I want to leave enough time for Q&A. So I think, Sean, maybe we just run through these with 10 minutes, and then I'll hand it back over to you to wrap. Does that sound all right?
Yeah, sounds good.
Okay. If you watch, by the way, if you watch any year-end planning videos, we do go into case studies in more detail. Maybe we link that out, Sean. Anyway, we have a year-end planning video where I actually go through an Excel model. Not as young as I once was. So I'm going to cover this quickly, but if we can't get to it, I think we'll link back to an example where I do go through it. But what are you looking at? So this is the model that I was sharing about where we summarize a P&L from a tax perspective into simple categories. So I believe this example is going to be, I see mortgage interest, I see closing costs. This is going to be in Airbnb. And I just got simple numbers in here to give you a flavor of how easy it can be on a small level. Obviously, if you're bigger than this, you've got multiple properties, you would have multiple projections. But the point is, you can see here that we start at gross receipts. We're taking out the Airbnb commission, which is 3%. And then we have our categories of operating expenses. Now, depreciation shown here, the 18,857, there's a calculation behind that. And essentially, it's going to be improvements. It's going to be the all-in purchase price of the property that's allocable to the business divided by 27.5. That's why that number is so big. And it's also why Airbnb is such a great tax strategy, because you're able to get credit for the full purchase price. And no matter what, it takes a lot of income, basically, right? So you can kind of tell that already it's going to take 19,000 of revenue to even start getting into profitability. So you look at this, you say, wait a minute, I'm already paying the mortgage, I already own the asset, and I've got 5,000 of revenue. I'm in a loss position. In addition, what you can see is supply. So guest amenities are kind of the number one category of expenses for Airbnb hosts that don't get deducted. Essentially, if you're buying wine, going to the store to get linens, things of that nature, those are guest amenities. We put them in supplies from a tax perspective, but it's a very high amount, as you can see here. But those two combined, you can already see that you've got expenses of at least 40,000, and you've only got revenue of 5,000. You're in a loss position. So usually for somebody in this that's kind of in that startup year, just getting going, your tax strategy is that you already have it, right? You've already started your Airbnb business. You've already invested what you need to. Now what's going to happen from a tax perspective is you're going to have a loss of 46,000. Here's the beautiful part. If you've made 120 joint alone on your W-2, what's going to happen is you're going to have that 120. You're going to now claim this loss. It's a pass-through loss, right? It's sole proprietorship, 46,000. So from a tax perspective, you're going to go from 120. Let's just make this 40. You're going to go down to 80, 74,000 if you're counting, 73,609 if you really want to know. But the point is you're going to go down to that amount, and all the taxes you paid between that 80 and 120, you're going to get back. And guess what? That's going to be taxed at your highest rate. So your tax saving strategy is this loss, and you've just gotten 33% of 40,000, which for anyone would be a very significant refund. That's why it's very important that you can project out before year end. And like I said, I think we do blast out, Sean, hold me to it. Let's blast out our summary P&L so that anybody who's on this call that wants it can do it themselves. But you want to get to that operating income. What if I'm in a profit? I've got a quick example here that shows you how punitive being on a Schedule C can be if you are profitable. So number one, know where you are profitability-wise, because if you're in a loss, you don't need to go to Target and buy a bunch of stuff to write off on your P&L. You've already got it. You've already done it. Enjoy it this year. Start thinking about next. However, if you are profitable, I want to show you how painful these taxes can be. And it's one of the reasons the S Corp makes so much sense once you get really profitable. The self-employment tax 15.3%, is brutal. This is what you pay as a Schedule C. So anyone who's got a profitable Schedule C, you already know this. So if your operating profit is 36, not only have you paid income on your W-2, now you're going to owe an extra 5,600. So usually what we try to establish is say, hey, look, you can get 15% to 25% of a tax reduction if you go out and spend X amount. So what does that mean? If you spend an extra $1,000 and your effective tax rate with self-employment tax is 30%, you are saving $300. So number one, if you are in a profit, just know spending $1,000 is going to save you $300. Again, that's deduction maximization. Now, let's just look at what happens as we extrapolate, right? At some point, let's just go to 2020. You can see we did this in 2018. So still applies though. If you are at a $300,000 profit, your taxes are going to be astronomical. At which point it doesn't make sense to go to Target and spend an extra $50,000. You just don't need stuff at some point. At that point, it's going to make sense to do an S Corp, which what we would be able to get reduced is that 20,000. So just so you can see it optically, let's look at 2020 with net profit that high. Moving into an S Corp would save that SE tax one line, 19,508. That's the benefit, and it maxes out, but that's the benefit of knowing where you are before year end. And I know that we have something like 6 weeks. This is a tradition of ours to get into it right before Thanksgiving. We know most of you are on your way to family or sitting with family and maybe thinking, you know what, why don't I step away for a little bit, So this has always been a webinar where we can get a lot of people's eyes on how am I doing? And my expectation is if you're on this call, you're either an A+ student, you've done everything, and you want to find out what we're doing that you're not, or maybe you're a last minute, I'm going to figure out where we're at on 12/31, and then I'll file my taxes on April 11th. Well, if you're on this call and you are that person, let me tell you, there's a big benefit to knowing where your profitability is going to be, because the number of strategies available to you go down significantly after 12/31. And if you want someone like us to help, we're not going to be able to serve you at our best level if we're trying to talk on Christmas. It's just not going to work. So let me wrap there because I want to get to questions. By the way, if you have questions and you need to go, put it in the chat. If you have questions and you actually want to hear them answered, go ahead and put them on chat, and Sean or myself will go through them, make sure we get to them. But with that, let me hand it back over to Sean. Let's wrap on what we've covered and how we work.
Awesome, thanks, Miguel. Yeah, so throughout the webinar, we did mention a couple of our services, namely the retainer and the on-ramp program. So those are kind of our main, I'm sorry, my decided question. Yes, we are taking new clients. But yeah, so those are our main ways of working together. So the retainer program offers kind of basically a pretty comprehensive setup. That's the purpose of the retainer, to assist our clients in getting their book set up, getting their tax and accounting situation structured. So under the retainer, we can take care of tax preparation, both state and federal, business and personal. So Miguel mentioned we have partnership LLCs, S corporations, and then single member LLCs. So we can handle all of that. We also offer bookkeeping services. So again, this goes back to just doing the bookkeeping structuring service. So we'll set up the chart of accounts. We'll set up all of the automation and rules within the softwares. And then we'll also structure just the bookkeeping software itself. And then we'll show you as a client how to use everything on your own. So by the time we're done with this kind of bookkeeping setup process, you will know how to maintain your own books. We offer full bookkeeping services, so we can maintain your books in their entirety. But if that's something that you want to have control over, we will show you how to do it on your own. We also offer entity structuring services, so we can form LLCs, S corporations, C corporations, and both single member and partnership LLCs. Again, Miguel mentioned that most of the entities we work with are single member and partnership LLCs, but we can go outside of that and form other types of entities. And then we also offer, of course, just general tax advising. So a lot of what we focus on there is just tax planning, really knowing where you're going to be at the end of the year. And that allows us to work with our clients and finding deductions, allowing them to kind of plan out spending money throughout the year, spending money strategically. We don't want people just to go out and buy a $2,000 business meal, right? It doesn't really add a lot of value to the business. So we work with our clients in figuring out, well, what will add value to the business, and that's where we want to invest our time and money. So our retainer runs for a total of $1,950, which again includes basically everything that I just reviewed. We also offer an a la carte service that can address those topics individually. It's just a little bit more pricey. So the retainer offers a discount on everything. Whereas the a la carte service is just specific to one particular service. You're just paying a little bit more for it outside of the retainer. Of course, if you have any questions about any of that, I'd be happy to hop on a call with whoever does. You can shoot me an email. That's my email on the screen, Sean@sharedeconomycpa.com. And that is our office number. So feel free to get in contact with us there. And then that's also our Get Started page. So you can submit your name, email, phone number, and then we will contact you within 24 hours of your submission of that. Yeah, if I hope that was kind of helpful. If you guys have any questions, Miguel mentioned, please throw them in the chat.
Yeah, I got a few here, direct message, and I'm happy to kind of bring out to the group, because if one person has questions, others do as well. And one of the things that, again, we just didn't have time to get into are these kind of deduction categories. So we also have people on the call that, maybe they're at let's talk about different magnitudes of losses. So if you have a $10,000 loss on a Schedule C, not a huge loss, not a huge tax write-off, you might be looking to increase deductions anyway, right? There might be things that you need in your business that you're like, okay, Miguel, you told me that 30% of my loss can be the tax that I get back. Now, a lot of this is fact dependent, right? You've got to have W-2 income, but all those disclaimers aside, let's say that's the truth, right? An additional $1,000 of spend is going to generate a $300 refund on your tax return. So as Sean said, you don't want to just go out and start spending money for the sake of spending money. There are times to go out and have a big expensive business meal, certainly. And actually for our married couples, that tends to be a quarterly meeting where you go out together, you have a dinner, right? You're going to tell me that you talked about real estate the whole time, right? You've got other ideas. You take an Airbnb trip, right? This is kind of the fun stuff that you can do where you get juice out of life, you get some business learning. Now, again, we're not recommending that you go out and do that and make your entire business a deduction play, because at the end of the day, it's about getting a return on investment. But if you are in this position where you're like, what are some of the things that your other clients are doing that they say is a good part of their business? We'll say Airbnb research, going out and investing time and learning about another environment, another market, whether you're in Turo, wherever you are, right? If you go out and stay at Airbnb, that can qualify as research. So there you go. You've made a trip you may have otherwise done has now become tax deductible. Those are the things that we're looking for. If you're going to buy a case of wine, part of it's for the business, part of it's personal. I don't know, not going to ask. We're just going to look at the vendor list, right? Coming back to how we look at business expenses. And we're going to say, is the amount reasonable? Is the vendor reasonable? Is the business purpose reasonable? Wine for guests is reasonable. $200 on wine is reasonable. Okay, wherever you got it makes sense. Those are the kinds of things that we think are completely comfortable to an extent. Where do things get checked and where do things get tricky? Again, can't cover too much on this call. This really is kind of level one. But coming back to the P&L, we do look at as a percentage of revenue. So in this case, meals and travel, 5248, is 100% of revenue. Now, this is an actual screenshot from a client. I can't remember who, but we deducted it. It was the first year of business. It's kind of high, to be honest with you. But again, it was legitimate. We brought it up. We talked about it. Okay, it makes sense. You had a lot of travel because this property was more than 300 miles from your home. It was a second house. A lot of business travel doing repair. You know what? It makes sense. So I think just kind of as a point, types of deductions, we definitely don't want to get cute, but we definitely don't want to leave any money on the table. So I'll leave it there as kind of a last, deduction play kind of comment before moving on. So if there are no further questions, I don't know if you got any, Sean. I might just share one that says, I have one property. What's the best way to work with you guys if I only have one property? I would say that you definitely want, if you haven't yet, you definitely want to see what a professional would do on a tax return. You'd want to see how we think about things. You'd kind of want to learn what the main issues are. And the real challenge, though, is we'd ask is, how good are your books? And if your books aren't all there, and you aren't someone that's going to actually watch all the YouTube videos on how to do it and do it in Excel, then you probably need bookkeeping help. So I would say, just getting started, if you really wanted to get the full experience and you're not ready yet to commit to a full retainer and do the entity setup and consulting and all that, the best way to work with this would be a bookkeeping catch-up, and then have us do the tax return. So kind of column 1 and 2 together. Very good. Got another question from someone says, we'll call you out here, but I'm an IT freelancer. How can a new computer be purchased to support the business? Is every 2 years too soon? Do I have to wait longer? Could it be every year? I would tell you that if you can tell me the story behind why you need a computer in any year, it's going to make sense. Computers are not what we kind of worry about. Back to kind of the vendor list, right? The 4 main things. If the vendor's Best Buy, that's not going to raise any eyebrows. If you're consistently running a loss as a freelancer, that's where you're going to start raising eyebrows, because a service business by definition should be profitable. So really it's kind of a net profit question. So if you've got the profit to support it, we were in an audit where the auditor was a super nice guy, meant really well. And he kind of said, he's like, look, I'm just looking for bad actors. And we had a client that gave us numbers, $1 million in sales, and the deductions kept adding up. And at some point, we said, hey, we'll sign it, but we want a disclaimer. We didn't do your books. It's kind of on you. And he got audited. And the auditor said, he's like, look, I'm not really looking at Louis Vuitton and marketing. I'm not really looking at the Gucci in advertising. He's like, you can tell me that that's reasonable. That's for you to tell me. It's an e-commerce company. But what I don't understand is how this taxpayer lives at this address in Los Angeles, which is, I looked it up on Google. It's a pretty nice apartment, and made $13,000, and that was his only source of income. So it was an interesting moment where I said, okay, so it's not necessarily about the individual things that you're writing off. It's about the big picture. And I would say that's true for this question as well. If you're showing enough net profit over a 3-year period where you're making money and you can afford your lifestyle, that's not going to raise eyebrows. What raises eyebrows is when you've got a store on Shopify that does $1 million in sales, and you live in a fully loaded, beautiful apartment complex, and you make $13,000. So that was early on in my career, and it was a good lesson about the big picture. And I still stay in touch with that IRS agent who's kind of a mentor to me now. So great. All right, Sean, did you get any other questions? Or are we good to wrap?
I think I'm good. I think I'm okay. I haven't received anything.
All right, good. And for those listening, we will edit this out when we put it up on YouTube. So Amanda, when you watch this recording, cut this part out. But for those on this call, we do have a special deal. So, the way to reach out through us, if you haven't been in discussion with us already and you're not already working with us, is to sign up on our Get Started page or reach out to Sean directly. And you can mention this deal and we will get it worked into whatever you sign up. Now, this is just for new clients only. So clients who are on this call, we love you. Take care of you, but this is a new client deal only. With that, thank you everyone for joining. To my team who's on, Sean and Leah, thank you guys as always. And everyone else, have a good Thanksgiving break.
Well, thank you guys.